Welcome, everybody, to another Aptora internal training webinar. Thanks for being here. For those of you who might be watching this on YouTube, this is internal training for the staff of Aptora and RA Tax and Accounting. If you're a contractor and you want a better accounting firm, then you should check out rataxandaccounting.com. We specialize in taking care of the contracting industry. Of course, you already know us at Aptora. Some of our staff at Aptora are required to be here, while others don't have to be here, and they come here just because they're trying to butter up the boss, or maybe they're just trying to improve themselves. I'm not sure which, one or the other. I guess we can do both here. Every week we pick a topic based on things we're hearing in tech support, training issues that come up. Today we're going to be talking about where do the numbers come from? Where do the numbers come from? So when I go to reports and I print a report, where do those numbers come from? There are a lot of reports, so we won't go over every one of them. Obviously, we couldn't. We'll focus on the reports that really make a difference, and that's the financial reports. So when a company talks about financials, they're talking about their income statement, their balance sheet, their statement of cash flows, and that's typically it. Sometimes there is another report regarding equity or retained earnings. But for a privately held company, when someone says, like your bank says, give me your financials, they typically mean an income statement, a balance sheet, and a statement of cash flows. That's what they want to see. So we're going to focus on these reports. The first thing I wanted to do today here was to get an empty database. And I didn't have one. I didn't have a database that was completely empty. So I started cleaning this database out. And I was almost finished when this started. What I want to do before I go any further is I want to set a new theme color so I never forget that this is my empty database. Because it's easy to log in and think that you're in one database when you're really in another. So you notice now it's gray. When I open up a form, it has a gray theme to it. Just a little tip. Let's go to File, go to Company File Information. This will tell us our record count. And I've eliminated almost everything that would affect our financials. And then some. So I see that I actually have some work orders left. I'm going to go get rid of those. Boy, generally, you'd never want to do something like this, start deleting stuff. And you wouldn't want anybody to have permission to do such a thing. But my goal here was to just get rid of things. GL accounts, that's my chart of accounts. I'm going to go to banking, chart of accounts. Here they are. And I'm going to highlight the top, highlight the bottom, and try to delete as much of this as I can. Some of it won't let me. So I'll say okay. Can't delete that one. Okay, okay, okay. Maybe okay to all. And we're going to go from 163 to 46. So it did not want me to get rid of some of these because they're in use. FICA payable, it's in use. So we'll leave those alone. I got it as close as I want to for this webinar. But what I'm trying to get rid of is this financial activity. You can see I have $2,000 here, and I want to get rid of that. What I want to do is go to reports, financials, go to reports, accounting, general ledger, and go to, say, the general journal. This shows all financial activity. I'll pick a date range of all, hit preview. And I started, by the way, with like 80 pages, which isn't much because this is a small database. But I'm down to just these two transactions that I just couldn't get rid of right there. So I can ignore those or I can adjust them off. You'll notice they are related to inventory and opening balance equity. So let's take a look at those. And the date, by the way, is worth writing down. So I'm going to take out a piece of paper here, 10/5/05, 10/13/05. Those are the dates that this general journal was affected, and those are the amounts. We have 981, we have 1023.50, and both are debit values. Now, if you are a total office manager user, I don't expect you to know what the debit balance on inventory is. But if you're an Aptorian, especially if you work in support, in sales, you should know what that means. So we have a debit 981, debit of 1023.50. On assets, debit makes them go up. So on our balance sheet, we should see 1023.50, and we should see 981 combined on the balance sheet. So we're going to go to reports, financials, balance sheet. As of today is fine. And yes, there's our balance of 2004.50. Where does this stuff come from? That's the idea behind this webinar today. So I have inventory here of $2,004.50. And someone might ask, I'm trying to get rid of this. I'm trying to have an empty database to train people on. And I don't know how to get rid of this. Where's it coming from? Well, that's the idea behind really mastering your accounting software. You need to be able to know where all these numbers come from off the top of your head. And there's many possibilities here, but the key was those dates. The dates that I wrote down were the key. So I'll just cheat. I'll jump ahead. I can tell you where they came from, and that would be the inventory adjustment, serialized items. I knew that because the credit value was opening balance equity. That's what told me it was probably a serialized adjustment. There's ways to figure that out. For example, I would just examine the inventory. You know what? I'm not going to cheat. I'm going to show you what I did. So let's go back to the general journal. Here I have an inventory account and an opening balance account. So I can see that those are the accounts affected, but what was the action that caused these numbers? Well, transaction type is right here, serialized adjustment. That's how I knew that. Another thing I could have done is gone to reports, accounting, general ledger. And I could have looked at transactions by account, all, and then pick the account. Here's what I'm going to do. I'm going to go to the serialized items and try to delete them. So delete's not an option. I'll take void. Says I can't. That's where I ended up with before we started today, is I couldn't get rid of those. So those are the only things left. The problem is that I don't want my balance sheet to show those. I want to start with an empty balance sheet. Come over to my balance sheet. It's completely empty except for that. So let's get rid of it. Let's go to do an adjusting journal entry. I'll open up the journal entry list, and it's empty. I've gotten rid of all of them. This is how we force numbers to appear and disappear. This is for full charge bookkeepers and accountants only. People, the average user should not have permission to the general or pardon me, should not have permission to the journal entry list, because this is how you get around the software trying to keep you out of trouble. The software was designed, especially with certain preferences activated, it was designed to try to keep you from making mistakes. If you know what you're doing, this is a great tool. If you don't know what you're doing, this gets you in trouble in a hurry. And it's caused a lot of tech support, a lot of headaches, a lot of angry people over the years. A lot of people put in adjusting journal entries. The boss never knows it. The next manager never knows it. Pretty soon you have years of these things really messing up your books. For the most part, for most companies in general, you probably would only have maybe 10 journal entries a month. And that's quite a bit. I know some companies that have 10 a year. All right. So we're going to go back to the 10/5 date, 10/05, 2005. That's the date we're going to affect our financials. And we're going to go find the inventory account right there. And remember, the inventory has a balance on the balance sheet. We're trying to get rid of it. So I don't know if we should debit that or credit it. Let's put our cursor in the debit. Look, there's a cheat sheet down here. A debit increases cost of goods sold, expenses, and assets. But hold on, inventory is an asset. Got another cheat sheet right here. Assets. If I want to increase them, I debit them. If I want to decrease them, I credit them. I'm trying to get rid of this number. So actually, I want to go to credit. And then I want to type in 10/23/50. Actually, it was 9/81 down at my notes. And so that should get rid of it. I hit save and close. If I do, it'll tell me, no, not so fast. Because you have to have at least one debit and one credit on every transaction. We know that from prior webinars. I have to have a debit, I have to have a credit. I can have more, but I have to have one of each. And when I get done, the two have to balance. So I know for sure I'm going to have to add a debit. I'll put my cursor here and notice the software went ahead and put in 9/81 for me. So now I have to find something else to go up, or go down rather. Well, it could go up, could go down. I guess I need to pick the account and talk about that first. I have to pick something else here. Usually, if you're trying to make inventory disappear, then you are picking a shrinkage account or possibly a cost of goods sold account. I'm going to pick opening balance equity because that was the other side of the transaction. Might remember then when we looked at that, go to it again. So we're going to go to the general journal, all. We have the inventory account that's on our chart of accounts. It's an asset, 9/81. The other side of it was opening balance equity. That's why I chose. That's why I chose to pick that. All right, so let's just set that aside. Right. Hit save and close. Double check my date because that's the date this is going to be affected. Close. Voila. Now let's hit preview again. And darn it, we added to it, didn't we? That's okay. We've added a transaction. I'm trying to get rid of them, but we added a transaction. But hopefully I'm making that number go down on the balance sheet because I want the balance sheet to be 0. Look at it. Oh, we're closer. We're halfway there. All right. So now let's do another adjusting journal entry. This time, the date is 10/13/2005. The account is inventory. By the way, this could be in any order. I don't have to do inventory first. Where are you, inventory? There you are. And I could go right down here if I wanted to and pick opening balance equity. Again, I want the inventory to go down, so I'm going to credit it. That seems counterintuitive, but we're all used to how our bank talks to us. I'm going to credit your account. I'm going to debit your account. But that's something different completely. They just happen to be using the same words, but it means something completely different. So now we're ready to adjust the 1023.50 down. And we're going to want to change opening balance equity by the same number. It didn't fill it out for us because we didn't go in correct order. Order is important in Total Office Manager. Flow is important, as we know. Well, let's go look at our cheat sheet again. What happens to equity? Stockholders' equity, or just call it equity. If you want to increase it, you credit it. If you want to debit it, it's going to decrease it. So decrease debit. What are we doing over here? We're debiting it. So a debit decreases it. So we're decreasing inventory and we're decreasing open and balance equity. And the reason why all this is important is this is where the money comes from. This is the really mundane, boring, I wish I didn't come to today's webinar. I'm glad you can't see me on the webcam because I'm so bored. But this is it. This is where the money comes from. When you understand this, then accounting becomes much easier. For some of us, we learn this because we have to, and we're not thrilled with it, almost like a college course that we had to take and we had to get an A. But others, like me, love it. I love this stuff because I like rules. I like rules. I like discipline. I like order. I like everything to have a place and everything in its place, like Ben Franklin taught us. So accounting for me is awesome because it's definitive. There are rules. And that's what one thing I think about when I learn programming. When you write code, there's all these rules. And that's what's cool about writing code. You can just make up your own stuff when you write code or you do accounting. So if you like rules, you'll like accounting. But I can promise you, this is the hard part. The rest of it's really easy. Once you understand debits and credits and what the accounts are doing, it's easy to go find all this and fix it. All right, so I'm going to hit save and close. And now we should have a balance sheet that's empty. Start closing some of these forms. Couldn't get rid of the serialized items. But that shouldn't matter. But ultimately, I probably got what I wanted here. We'll go to preview, and we have a balance sheet with nothing on it. Now let's go to reports and go to the other financial statement, the balance sheet. Whoops, not the balance sheet. That's not what I wanted. I wanted income statement. And let's just do all. You probably would never do all income statement. Let's do it. And it's all zeros. So we're good. We have a blank database to work with. No numbers. All right. Company file information, like I said before, that's where I like to go to see what's in the system, and I can start getting rid of those items. Now, let's create an item. And this would be a good class to do at your own company. Teach people how all this works. We're going to create an inventory part, and we'll call it something very simple so we know. We'll give it a description of inventory part so we know what it is. and we'll put in an estimated cost. This is what we think we might pay for it someday. We don't have any right now. Go to the inventory tab, the accounting tab, and we have to pick the income account and the COGS account, cost of goods sold, and the asset account. Those are coming from the chart of accounts, that whole list of accounts. And that's how the income statement and the balance sheet know where to put all this. So on the income account, we only have a few because I went in and tried to delete them all. So we'll just keep that one there. Or we could add new. Let's do that. Let's add new income. Give it a name of inventory part. That would generally not be a great name, but that way we know what it is. We'll be able to find it quickly. What best describes it? In this case, we don't need this, but get in the habit of populating that. Click OK. COGS, we have these left over. So I'll do add new, cost of goods sold. That is going to be an other current asset. You won't, pardon me, wrong field. Cost of goods sold. And we'll put in inventory part, but we can't duplicate the name. So I'll add COGS to that. We're set there. Asset account. That's what I skipped to a minute ago. Inventory. That's left over. That was in there. I couldn't delete it because it still had some activity, which we zeroed out. So we could still use it. Why not? So whenever we produce income by selling these, the software now knows that goes on the income statement on a line item called inventory part. And whenever we recognize a cost for these, we buy it and then sell it, it now knows where to put that line item on the income statement under COGS. On the asset account, inventory, it now knows where to put that. That's an asset, so it goes on the balance sheet because it's an asset. Hit save and close. Now that we've created it, let's keep an eye on these reports. Let's look at our balance sheet. Where is it? It's gone. It's not even there. When are they going to fix that bug? Well, that's actually something somebody said to me. I put in an item. I've been putting in items all day and they're not on the balance sheet. Well, we've been putting in the items, but we don't have any yet. And certainly there better not be anything here or we've got a real problem. Nope, there's nothing there because we haven't sold it to anybody. It's just in there, ready to be dealt with. So let's deal with it. We should always create a purchase order first. So we're going to do that. We're going to go find that new item that we put in here. And it looks like we have a lot of items. That was something I forgot to get rid of. Just do that. Let's go to invoice items. And let's highlight every one of these. Let's go find the one that we just put in. Right, where are you? Right there. And I use my control key. I'm going to use my control key. It's not going to let me do that for some reason. Time to try to fight with it. So I'm going to go up to that item. Shift key, right click, delete. Some of them, yeah, it's not going to let me because it's in a purchase order. we're going to go to purchase orders. And this is important because this is how you delete things. People do have legitimate reasons to delete. You have to start at the top, work your way down. So it's important that you just get rid of the things from the top level down. It usually starts like at a bank deposit. Now, it let me get rid of a lot of those items. Some of them it said used in a group. Fine. I wanted to go through this exercise so that you could see also how things get deleted and how they're protected against it. The one thing it complained about is, well, some of these items were used in a group. We'll see that again. Now that the parts are freed up, start getting rid of those. I'll give it one more try and then I'll move on. All right, so we whittled it down quite a bit. I'm going to start with a purchase order. We have a lot less to pick from now, don't we? How much are we buying it for? Well, we'll just pretend like we are buying it for $100. I'll hit save and close. Now we'll look at the balance sheet and what? It's not there. Well, that was a purchase order. That was a permission slip to buy it. Doesn't mean you have it. You don't have it yet. You only have a permission slip. So it's not on the balance sheet. It's not on the income statement because it's an inventory part. We got to go through the process of receiving it. So what we'll do now is now that it's on order, we'll go to receive items. We'll pick American Standard and it says you've got a purchase order for them. And notice that it makes it easy on us. So now we've received the item into inventory, into where? The main warehouse right here. Could make it a different warehouse. It's a $100 item. So I'm about to take possession of it. When I hit save and close, I'm going to add $100 worth of inventory to my balance sheet. And that means I'm going to debit inventory. I'll be debiting inventory. That makes it go up. You might remember earlier, though, I said we also have to have another credit. We have to have a debit. We have to have a credit. We have to have at least one of each. We can have more than that, but we have to have one of each and they have to be in balance. So I'm going to also have to credit something for $100. Well, I'm going to need to increase something, $100, called liabilities, accounts payable. So I'm about to take on an asset of $100, but that just can't come out of thin air. I have to have the bad news. The bad news is I owe somebody $100. So when I hit save and close, as of 5/14/20, I should have these two numbers on my balance sheet. 5/14/20. As of 5/14/20, hit preview. There it is. I've got $100 in inventory, and I've got $100 in accounts payable. Happens to be American Standard. I owe them $100. How much do I have in income? I have none. How much do I have in cost of goods sold? I mean, I just paid $100 for it. I have none. Because of why? Because it's just an asset. You might say, well, I bought it for a job. Yeah, but you haven't given it to the job yet. Well, yeah, I did. I took it out there today. Then you haven't invoiced them yet. We have to create an invoice first. Let's do that. By the way, remember on this balance sheet, you don't pick the right date, it's zero because it's as of the 14th. That was the transaction date. Common question as well. Let's go create an invoice for that item. You can see the cost is $100. I can't edit that because that is something that happened during the accounting process, the bookkeeping process. We bought it. I can't edit that. Certainly decide on how much to sell it for. So I'm going to sell it for $200. That'll give me a gross profit of 50% or $100. And check the date, 5/14. Maybe we do that the next day. Maybe it's the same day. Save and close. Ship date, that's okay. That's a preference, by the way. All right, so now if I go look at my balance sheet, it didn't change. Why? Another bug. Nope, it's the date. People get that wrong all the time. It happens. I mean, I do it too, just not thinking. But we got to get our date correct because we had an invoice for the next day, the 15th. So now we have no inventory. It's gone. We have accounts receivable, though, of $200. Somebody owes us $200. That's the good news. Bad news is we owe somebody $100, but we came out of that okay. We have net income of $100. So we bought it for $100, sold it for $200, we pocketed $100. That's how the rich get rich. Not really. There's a lot more to it, isn't it? But we're keeping it simple right now. And we should be able to go to our income statement. This time we would want to do this year. That's more likely what you would do. Then you would pick the date, say May 15th, ending May 15th. Now we have similar information. We show the income. We show the cost of goods sold. And we haven't done anything else, so it's just pure profit. Truth is, we would have had labor and other things. That's where the money comes from. And if you want to dig into these, you would double click on these numbers. So I just double clicked on income, pardon me, inventory part, but it's income. And I was taken to the transaction detail by account, and that tells me more about it. It was an invoice. So let's double click on the invoice. And here it is. And we can go to menu, and we can go down to find in the GJ. And this is a tiny version of what we were looking at earlier. The report we were looking at earlier, this is just a small version of it. It shows us how the money got there. It shows us the credit and the debits and the accounts involved in this invoice. So when we created this invoice, I didn't indicate that they paid us. So we created an accounts receivable of $200. That's an asset. So to make it up, to make that go up, we debited it. And you saw that on the balance sheet. Like I got rid of the balance sheet. Thought I left it open. So on the balance sheet, we saw that. Then we had an inventory part, income. Credited that, $200. Income, if you want income to go up, you credit income. Go back to that cheat sheet. Operating revenues, that's just another word for income. You want to increase it, and you credit it. Credit that. So Total Ops Manager knew that, thankfully, and credited. And then we had inventory. We had an account called inventory. You might remember that's on our chart of accounts. It's an asset, an other current asset account. That's how we track our inventory. Well, when we sold that item to Acme Brickyard, we got rid of it. And we finally recognized the cost of $100. So now we have inventory going down by 100, and our cost of goods sold went up by 100. It's an inventory part, so that didn't happen until we created the invoice. And again, once this is absolutely so clear that you could write it with a pencil, that I could tell you a story about accounting, about bookkeeping. I could tell you a story about bookkeeping. We ordered this, we created that, we did the other thing, and you could take a pencil and write down all the credits and the debits and the accounts. You could just fill in the reports. You can do that. You'll be able to find almost any number in the program and explain where it came from and fix accounting issues and so forth. All right, so that indicates what happened on that invoice, and we'll save and close this report here, that one too. Now we're going to create another item. This time we're going to create a non-inventory part. We'll give it a name on the part 01. Non-inventory part. How much are we going to sell this guy for? Well, we'll probably sell it for, say, 150. Give it a different number. We'll go to the accounting tab, and the only thing we see is income account. Make a long story short, you should always check this box there. We will check that box. Now we'll pick our income account, other sales, HVAC. Why don't we create add new? We'll create a new income account just so we can track this more easily. And it'll be income on non-inventory parts. Non-inventory parts, that makes it easy to track. And for cost of goods sold, we'll do the same thing. We'll add new, we'll find cost of goods sold, and we'll give it the same name, but we can't duplicate the name, so I have to change it slightly. I'll just add COGS to it. Click OK. Save and close. Notice there's no asset picker because this is never an asset. This is a non-inventory part, so you don't have any. Now, this is absolutely the single biggest confusion when it comes to job costing and financial reporting in general. People use non-inventory parts and they're not totally sure how that's affecting their job costing. They don't know how it affects their balance sheet, their income statement. And weird things happen and they don't know why. And oftentimes it just looks like bad software. This is never an asset. You never have this. That can create problems. It can also be the appropriate choice, but it can create problems. I'm going to hit save and close. And like we know before, these two financial reports should not be affected at all because I've just simply added the item. Now we'll go back to vendors and we might create a PO for it because we need to order it from somebody. And what might this part be? This part could be something that you really buy and it's tangible. I mean, it's really a thing, but you never intend to keep it in stock. Never. So you contact American Standard and you say, hey, that rooftop that I ordered from you, what about it? I forgot to order the curb. I need a curb. And they say that's a special order item, non-returnable. Oh, okay, well, that's fine. I know I need it and I know I'm not going to return it. So you might legitimately want a non-inventory part. And let's say that we have that curb on order and it's $400. It says that you've changed the estimated cost of that. Do you want to update that field? I'll do it for now. Yes. Now it's on order. So as of the 14th, it's on order. Save and close. These two reports are not affected because it was a permission slip to buy something. That's all it was. you ordered. Now it's arrived, and they ask you to come get it, come pick it up. Maybe you do. There's a packing slip. There should be. There better be. You match the packing slip to that curb that you just bought and took out to the job. You turn the packing slip in. Now we receive the item into inventory. This might as well say enter a packing slip. The vendor was American Standard, and once again it says, I know American Standard. You got a purchase order for them. Makes it easy. We may not know the price at this point. We're just a packing slip person, but the price came over from the PO. We do put in a reference number, put in any memo we might, rooftop unit, curb. Double check this date, 5/14, like it's the next day. Now we hit save and close. Only two accounts are about to be affected, income and COGS, because there's no inventory account, there's no asset account. So I'll hit save and close, and right when I do that, I'm recognizing cost of goods sold. Even though you haven't installed that curb, it's a non-inventory part. That customer is committed to it. They're committed to it. They don't have a choice. Non-refundable, non-returnable. Hit preview. Nothing's changed on accounts receivable, right? Because I haven't created an invoice. There is no inventory asset, so inventory is still zero. Liabilities, that went up $400. Net income, we went down. We're losing money now. Now we're losing money. Now party's over. Net income, we're deep into the red. And if we look at our income statement, it shouldn't be affected on income because we haven't sold it yet. But look what's happened. Our losses have deepened. Our net loss is 300, as we saw on the balance sheet. Balance sheet, by the way, keeps a running annual total of your net profit or loss. And how did this happen? Well, $400 was added to this account, the non-inventory parts COGS account. And that's fine because it's a special order part. They are going to pay me for it. I might as well recognize the cost today because I've taken delivery of it. I've taken possession of it. So I'm on the hook for the $400. And they're on the hook for it too. So I'll eventually get my money. Now, if you don't like this behavior, it should have been called an asset, and you should have waited to recognize the cost of goods sold when you actually sold it to them through an invoice. But see, it's important that the user understand what they're getting into here, and then they can do whatever they want. Many people don't understand this. So they see the software is flawed or something's wrong, and they just don't know what it is. We're talking about very fundamental things that are pretty easy to explain. I realize that many of you deal with numbers that are far more complicated, harder to investigate. However, the principles are the same. So now we have the $400 as a COGS, and we know how it happened because we called it a non-inventory part. It did not have an asset account, so it never appeared on our balance sheet. Now we're going to invoice it. So we'll go back to our friends at Acme Brickyard, and we will go find that curb. In this case, we were using a generic non-inventory part number. Wouldn't be a bad idea to actually create the item and call it RTU curb and give it a model number, serial number, batch number, identification number of some kind. Wouldn't be a bad idea to do that. But this is a webinar. We made it simple. Now the cost was $400. And it suggested 150 because that's how we set up the item. And you'll want to change that to something that's profitable. Maybe we're going to be achieving a 50% gross margin, so we double it. Or maybe $600, we'll sell it for 600. We paid 400, 33.3% gross margin. Double check that date. Let's make that tomorrow. Now I'll hit menu save. They don't show me that. Let's go to menu, go down to the find in GJ. Let's talk about what just happened. This is a lot less complicated. A lot less on here, isn't there? Accounts receivable just went up $600. We debit assets, and accounts receivable is an asset. So we went up $600 because that was the sale price of the item. And then where our income went up $600, so we credit income to make it go up. And there's nothing else because, again, this was never an asset. So we're not dealing with that part of it. Save and close. Now we'll look at our balance sheet. And our accounts receivable has gone up by $600. And our liabilities are the same because nothing's really changed there. We still owe American Standard $500 at this point. Good news is we're making a profit again. Let's take a look at our income statement. Our income statement is improved because we added the $600 in income from the sale of that non-inventory part. Our cost of goods sold has not changed because we recognized the cost of goods sold back when we bought it because it was a non-inventory part. It was never an asset. Our income has increased, so we're no longer in the red. Now we got a $300 net profit. Some people will call me and say, our income statements are all over the place, up and down daily. One month when it feels like we made a lot of money, I'll look at my income statement and it's disappointing. And then the next month, I feel like we had a disappointing month and the income statement's fantastic. And then the third month comes along and I don't know what to think of it. What is going on? Well, this is it. So what we see is we see the matching principle that accountants like to talk about, where you match income to costs as closely as possible. The matching income is not being observed. So we really want better bookkeeping so that the income statement reflects more accurately and more timely, our income producing activities. That's why an income statement can feel like it's just jumping all over the place. All right, so we've invoiced that job twice now. Maybe we're finished with them. Let's go take a look at our job costing report. We have many of those, but we'll just go to all, Acme Brickyard, preview. And our net profit is $700 on income of $800. Not bad at all. That's great. In fact, that's so great, I don't believe it. That is so good, I don't believe that. How can my cost of goods sold be $100? So we got to figure out what happened. Only $100, my cost of goods sold. So where did the money come from? That's how we started all this. Well, I just ran into another problem. The job costing in the software stinks. Shows I got $100. That can't be. So let's go to customers, customer list, Acme Brickyard, right click, go to history. Let's change the date to all just in case. We have our 2 invoices. That's good. So those are there. The 2 invoices are there. So let's open one up. There's the inventory part. Okay, good. Let's right click on that inventory part. Let's go into its history. I can see where we sold it, item receipt. That's where we bought it. There's the $100. Let's open it. This is the only one showing up. So one thing I can see right away is I didn't pick the job name, Acme Brickyard. So I need to fix that, because that way that line item now is being associated with that job, that customer. This doesn't have to be saved and closed, but I've examined that item. Let's look at this other one. So I'll open this one, $400. Right click. Let's go into that item's history. Item receipt. Open it up. No job. Let's pick the job. Don't have to hit save and close because I didn't make any changes to it. All right. So now I fixed that. Let's have another look. Let's double check my date, 5/15. Yes, it should be fine. I said all. Let's hit preview. And now all of a sudden, we have a lot more COGS and the net profit is a little more believable. So that's how we fix job costing. That's very common. To have job costing look too good, look worse than it is. Job costing report looks better than it is when you forget to add the job name on your financial transactions. It's important to add the job name to all of your transactions, all of your timesheet entries, etc. It looks worse than it is sometimes because you added costs that didn't really apply to the job, or you used non-inventory parts incorrectly. One of the problems with a non-inventory part is if you identify a lot of things as non-inventory, they become part of the job costing report, even if you don't use them. And then you return them back to the main warehouse and use them on the next job. The next job doesn't pay for those. They're free. It's a non-inventory part, keep in mind. So it became a cost of goods sold the day you bought it. And if you took it out to the job, like a 500-foot roll of copper, and you used 50 feet of it and brought the rest of it back, the next job could take that entire 450 feet of copper, wire, pipe, whatever, and use it for free. And it will not show up as a cost of goods sold. So for that reason, any significant money that gets spent on a job, if it's going to be a non-inventory part, you have to make sure you're using all of it on that job, or you're returning it to the vendor for a credit. So we could continue with other examples, but they all do the same thing. They all do the same thing. As we run through here and we spend money, it all does the same thing. The key to remember is that You're driven by your chart of accounts. The chart of accounts, which shows income, cost of goods sold, expenses, assets, liabilities, etc. That chart of accounts is really important to thoroughly understand. And then you want to understand how those account types, chart of accounts are basically assets, liabilities, income, expenses. It's important to understand how the debit and credits affect it. And then when you do that, when you understand that, then as you start entering transactions, like buying inventory parts, you'll know how these things are affected. All right, let's do one last thing. Let's go to vendors and let's go to enter a bill for items that we have received. These are your item receipts. There's no bill yet. Tom is very nice. It's going to make it easy on us. I'll pick both of them and click OK. It says, are you sure? Yeah, I'm sure. And it's entered in my bills. There they are. Now, if they send you a paper copy, this is your time to double check the money. Make sure they charged you properly. If they didn't, get on the phone with that vendor. Phone number's right there for a reason. So now we've converted those to a bill. Those are the terms, 2%, 10, net 30. If you pay me in 10 days, I'll give you a 2% discount. Otherwise, I need my money in 30 days or you're late. Set up as many of those as you want in the program. Now let's go to vendors. Let's go to pay bills. By the way, nothing's happened to the balance sheet or the income statement. We just converted the item receipts into bills without changing the money. Now we're in the pay bills form. The vendor is American Standard in both cases. So I check those boxes. The software says, hey, you got $8 coming. We're going to give you $8 off because you're paying early. You're paying within the 10 days. The software knows that. So we'll select, forgot to select my discount account. It needs to know where to put that. So we would pick the proper account. And this could be many different choices. But I'm going to pick that one. And it click the button. It auto discounted the first one. Auto discounts both of them. So there's the actual amount we're going to pay. Right there, amount to pay, amount to pay. Payment method, check. Or we could use a credit card. Say a check. Payment date. I plan to mail in the check on the 18th. In fact, what you'd really do in real life is you'd go pick the date and mail them the check in the last moment. You'd pick that future date and hang on to that check. Make out the check, put it in the envelope if you want to, put a Post-it note on there. Don't mail it until you have to. You're doing a transfer, do the transfer at the last minute. Get used to hanging on to your money. Going to want to know what payment account, what bank account to draw from. And we'll do pay and close. Now, our job costing report hasn't changed. Has nothing to do with job costing. Our balance sheet should change, but we got to make sure to pick the right date. Let's just do the end of the month. Just make sure we get it all in there. Let's hit preview. Well, first of all, we're overdrawn because we didn't even have any money. I got rid of all of our money. Remember, I was deleting everything. So we're overdrawn. But the good news is we don't have any accounts payable anymore. The accounts payable is gone. The accounts payable is money that we owe people. In this case, it was all owed to one vendor. So that's gone because I paid my bills. Bad news is I'm overdrawn. Good news is I've got a net profit. That's a whole nother webinar. If the people ask me all the time, how come my net profit isn't the same thing as cash on hand? You know, if I have 50,000 in the bank, but I made $100,000 last year, how come I don't have $100,000? That's That's a whole nother webinar. Two are not related directly, right? You can see that from this. I'm overdrawn. I got to get my money. People owe me $800. Now, let's go to the income statement. Income statement doesn't care that you're overdrawn. It's not the income statement's job to talk about that. It doesn't show you cash on hand. It only shows you that, yes, in fact, you have 800 in income. You've got 500 in cost of goods sold, gross profit of 300. Currently, there's no overhead, so it's all net profit. So what you have in your checking account and what you owe American Standard and what people owe you doesn't make any difference to the income statement. Even though you haven't been paid, that work is done, it's been invoiced, and it's over. So let's do one last thing. Let's go to customers and let's go to receive payment list or just directly to the form. And you could have got here through the invoice too. Let's find Acme Brick Yard. Let's pick the date that they paid us. They paid us on the 18th. And what method of payment did they use? They sent us a check. There's the check number. How much money did they send us? Oh, maybe they sent us $800. So let's type that $800 in. Go down here and pay this guy here. Pay this guy here. So we're collecting on those two. So we're about to collect $800 as of 5/18. And we'll hit save and close. Now, when we go to the balance sheet, what? We're still overdrawn. Knew there was a problem. Wait a minute, what is this? Undeposited funds. Why is it undeposited funds? You haven't deposited it yet. That's part of bookkeeping. It's on your desk somewhere. So someone has a check or two checks, one check, I guess one check in this case. Somebody has a check for $800. I want to know who's got that check. Who has it? Technician has it. The installer has it, maybe. Or in this case, they mailed it to us. So Betty has it. Go talk to Fred and get our check. Now, the income statement should not have changed because, again, it doesn't care about it. It doesn't care if you get paid or not. I know you do. Let's go to banking. Let's go to make deposits. It says, well, somebody's got a check. That's what that message box basically says. Somebody has got a check. Go find it. So let's go find it. I'll click the payments button. There it is. There's that check. I'll click close. And it's saying here that you've got a check you're about to deposit. It's going to ask me for a bank account if I try to save it. I could do a better job of deposit as a memo, right? You should generally. So it's about to deposit money on behalf of that customer from an account called undeposited funds. Can't change any of that. There's your check number. You could edit that if it was done incorrectly. You'd know because you're holding the check. And now you're ready to hit save and close. And the software has to trust you. It has to trust you that you, in fact, will go to the bank and deposit that money. Hit save and close. Now we'll go back to our balance sheet, and the undeposited funds is gone. And we're back. We no longer have the bank calling us and telling us we're deadbeats. We're not overdrawn because we made the deposit. But did we? Did we really make the deposit? Or did they run off with the money and leave the country? Probably not worth it for that kind of money. But in all honesty, we darn well better make sure that the money got deposited. So we get the website up. We get the banking website up. And we keep our eye on it. And as soon as we notice that the bank has acknowledged the deposit, then we go to reconcile accounts. and we find that bank account that we've been watching, and we pick the today's date or the statement date. We just need a date in here that will encompass that deposit. There's the deposit right over here. So when we see that hit the bank, we tell the software, relax, it's there, okay? The money made it to the bank. I told you they wouldn't leave the country. And when we notice that American Standard has deposited their check, darn it, we check that box too. Now, we're not ready to fully reconcile this because the bank hasn't sent us the bank statement, or at least we haven't gotten to the date where it's all done. But we can reconcile as we go. Don't reconcile at the end. Reconcile as you go. That bank account website opened up frequently. We do it daily. Now it's saved for next time. We don't have to continue, like reconcile now. We don't have to continue with the reconciliation. We just hit save because that's really all we want to do at this point. And then you'll come back and you reconcile later. Now, by doing what I just did, the balance sheet's the same. The income statement is the same. Job costing report is the same. Finally, everything we've been doing has been recorded in the general journal because it knows all transactions. So we'll pick all as our date range, preview. There's everything that we've been doing. All the credits, debits. So if you want to know where the money came from, where it went, you want to know every detail about how the money flowed through the accounting system. This will show you everything right down to the deposit. It'll show you where all the money went. And it should show you debits and credits are equal. Software takes care of that automatically in the background. It is possible that they can become out of balance due to a problem that can be fixed. That's a different webinar. It takes care of that in the background for you, and this shows you every detail about the transactions, check, payments, etc. That's how you know where the money came from and where it went. And then finally, I mentioned something earlier, and we never talked about it again. I said that your financial reports were an income statement, a balance sheet, statement of cash flows. There was a fourth one, but we usually don't deal with it. Well, I want to see my statement of cash flows. I want to know how I ended up with $100,000 in sales, like that caller asked me once. Or pardon me, he had $100,000 in net profit and roughly 50 in the bank. How did that happen? I said, go to your cash flow statement because it tells you everything. Cash flow statement will show you all the money coming and going. Not a lot to show in this case because the good stuff happened later. So in this case, it shows us how to get, see how important the date range was? I made that mistake. That was not me trying to be tricky. I wondered why it was blank and got nervous. True story. That I really did. I was like, uh-oh, I better edit that out. And then I realized I picked the wrong date. So it happens to all of us. But this cash flow statement shows us how we got our $310. It shows all the money flowing in and out. Under most circumstances, it's way more detailed than this. But if you ever wonder how you can have net profit of 200,000 and you've got 110,000 in the bank, this will tell you. If you've ever wondered how you could possibly have 600,000 in the bank and you lost $42,000 last year, this will tell you, because that can happen too. It's just changes in those account values. You might have collected on a big job. You might have paid a big bill. Your uncle might have given you some money. It all shows up here, but those activities, all of them don't show up. All cash activities don't show up on an income statement or balance sheet. Statement of cash flow shows all activities related to money coming and going when it's cash on hand. That's it. That's where the money came from. Does anybody have any questions about anything that we've seen here? Okay, none. That's good. Hopefully, this will really help you understand the accounting system. I don't like teaching debits and credits. I don't like talking about T accounts. I don't think it matters. I just like teaching it this way. Now, one question we saw is there a way to update the retail price for a group of items using a markup method? And we do have a tool under the company, and we have a video that talks about this, by the way. I can't remember the title, but it's one of our recent inventory videos. What this utility does is it allows you to go through and update all of your retail prices. And how does it work? It just looks at the cost you've been paying or whatever you've decided here, and it creates a retail price. It also has another feature where it'll add a markup method if you don't have any. Or pardon me, I misspoke. What it'll do is it'll use a markup method rather if there isn't one selected. So we'll take a better look at it. Let's go to our item that we created, the inventory part. Get it right here. Go back to that adjustment, state retail price. Now, this particular item has a retail price of 0. It has an estimated cost of 100, average cost of nothing because we don't have any in stock, and it doesn't have a markup method. Not a real good candidate to be marking up our price. Typically, we're going to update our retail price when we have that item in stock. But this is where you do it. This is where you decide what markup method you'll use in case it doesn't have one, like this one. And then how do you want to create the retail price? And you have these 4 options. And then what if the retail price field is, or pardon me, what if the retail price has something in it already? Do you want to ignore it? Well, most of the time you don't, but you could use this utility to just simply fix those that don't have a retail price. That gives you the option of ignoring anything that has a retail price. Typically, you're not doing that. You're typically updating all of your items to reflect recent changes in the price that you've been paying. Any other questions? Okay, good. Well, I think that was a good webinar for all of you interested in how financial statements get their numbers, where the money goes, where it comes from. And if you have any questions on this, please let me know. If you watch this on YouTube, feel free to comment on the video or send us an email asking us for clarification. We're happy to do that for you. Also, happy to take any video suggestions that anyone has. Just let us know what you'd like to see. We'd be happy to do that. Thank you, everyone.